Good afternoon and welcome to our webcast. Today our topic is taxation of internet sales in Puerto Rico. First of all, we want to thank you all for joining us today for this discussion. I'll be joined by Javier Oyola, tax manager here in Quebec Grand Thornton, and by Chuck Jones, a director of the SALT practice from the U.S. Grand Thornton firm. Remember, this is a training or a webcast. It's not an official consultation. So if you need to make or arrive to any conclusions or need help with any issues, please know and remember that this will not suffice as a tax consultation. First of all, we want to share with you our vision, mission, and values. Our vision here in Quebec Grand Thornton is becoming the firm of choice in Puerto Rico, and our mission is to help our clients achieve their business and personal goals. We do this through the performance and engaging in our values, which are summarized in the acronym CLEAR: collaboration, leadership, excellence, agility, respect, and responsibility. And today we are putting into practice several of these values, especially collaboration, where both firms, the Puerto Rico firm and the U.S. firm, are putting together this webcast for you in order to provide you more information on the state of law regarding internet sales. Our agenda for today is first we're going to give you a little brief description of our current fiscal and tax situation in Puerto Rico. Then Chuck will give us a background and current state on taxation of internet sales by states in the U.S. This is very important for us in Puerto Rico to be aware of what's happening in the states and what's triggering the treatment or Puerto Rico's response in this area. After that, Javier is going to talk a little bit about Puerto Rico's plan to tax internet sales. And at the end, we'll have some time for questions and answers. Just for you to have a picture of your speakers today, we have there Chuck from Grand Thornton, U.S., myself, and Javier. So before we start the discussion, I want to give you some housekeeping notes. First of all of you are muted. So if you need to communicate with us, please do it through the participant feedback box on your screen. We have people here attending and keeping track of what's coming in that chat box. So please use that chat box for any issues or concerns you might have, as well as for the questions. Sometime during the presentation, you are going to receive an update message from the call center, and there you're going to find a link to the deck slides. Okay, so keep in mind that you're going to get this updated message to get the slides. First of all, we would like to know, how did you find out about this webcast? Was it through our mailing, through a Facebook post, or a LinkedIn post, or any other way? Take some seconds to answer that one. Great. Thank you for your answers. It seems that most of you find out about the webcast by our mailing. Some of you by other means. If you please could be so kind, and on that chat box down in the screen, write down what that other was. By hearsay, somebody told you, because we want to know how you're getting our message. Okay? Thank you. Just a brief summary of state of affairs in Puerto Rico. You are probably all aware that Puerto Rico is dealing with the debt negotiation with bondholders, as well as we have been assigned by the PROMESA Act that was approved summer last year by the U.S. Congress. We have been assigned an oversight board, and the board has already started the procedures and the oversight over Puerto Rico matters. The fiscal plan, which was submitted by the current governor, was finally accepted in March and certified in April by the board. We need to keep in mind several important dates that are coming up. The first one, and it's not there because it's tomorrow, is April 28th, and that's the date that the governor has to submit the budget to the oversight board, the next fiscal year budget. And that budget needs to show a positive cash balance. So that date is tomorrow, April 28th. The board has then until June 30 to certify that budget. That means to approve and certify that budget. So we're going to have 2 months probably of negotiations between the board and the governor on how that budget is going to end up. June 30 is a very, very important date. By June 30, the government, Puerto Rico, has to have an additional escrow amount of $200 million in order to avoid the application of furloughs of government employees starting July 1st. In addition to that, they need to have cash liquidity as of June 30 of almost $300 million, $291 million. So we're talking about almost $500 million in excess cash that the government needs to come up in order for the furloughs of the government employees not to start in July 1st. Then the next very important date this year is September 30th, where a determination is going to be made as to whether full or partial elimination of the Christmas bonus of the government employees is going to be applied. The only way this partial or full elimination of the Christmas bonus is not going to happen if enough savings measures have been or will be timely achieved by the government. So those 2 dates, are very crucial in our current situation. So it has been estimated that the amount of sales and use tax, EVU, that is not collected on online sales was around $100 to $125 million. That was the amount included in the introduction to the bill of the House of Representatives 849 that we're going to be explaining later on. This number has been revised to be between $35 and $55 million. And the fiscal plan includes the figure as $44 million. So it has been lowered from the initial estimate, probably to have a more conservative number. House of Representatives Bill 849 provides for notification and reporting requirements for remote online sellers. The original draft or the original bill is the one described in our presentation. 2 days ago, the House of Representatives approved the bill with some amendments, and Javier is going to be mentioning those amendments through the presentation of Bill 849. So we still are pending. This bill has to go to the Senate and be approved by the Senate, and we expect some changes to come out from the Senate. So once the bill is finally approved, we'll issue an alert so you can have the final requirements and stipulations of the law. One of the reasons, as you might be aware of this bill, is to raise the collection of sales and use tax, and the other one is to level the commercial field for local merchants. Local merchants are suffering big time because of the online purchases, because people buy online and don't pay the 7%, the 11.5% sales and use tax, while if you purchase in Puerto Rico, you're going to be applied the sales and use tax. So this is creating a very bad situation for the local merchants because of people buying online. So that's as a way of introduction to our webcast today. Now I leave with you, Chuck, with the background from the States.
Okay, thanks, Maria, and thanks for inviting me to join your webcast, too. I appreciate that. And there definitely is a lot going on in this area, too. First of all, I'd like to do a little bit of background then, too, in terms of the constitutional standards and that type of thing that applies to it. First of all, there's the Commerce Clause, and that provides that Congress has the power to regulate commerce among the several states. And the other key constitutional provision is the Due Process Clause, and that provides that no state shall deprive any person of life, liberty, or property without due process of law. Now, Nexus is required before a state can impose a tax. And in terms of the Due Process Clause, then, this really concerns the fairness of subjecting the taxpayer to a state's tax. And it really involves some definite link or some minimum connection, then. And the minimum connection is satisfied if the taxpayer purposely directs its business activities toward the residents of a state. Now, the Commerce Clause then requires a, quote, substantial nexus with the taxing state. Now, Congress has the power to regulate commerce among the states. Now, for use tax collection, this requires a physical presence. Now, however, for income and franchise taxes and other entity-level taxes, a physical presence requirement may not be necessary. So, like I said, it really varies among tax type then, too, if there's a physical presence requirement or not. And then one of the key cases that I'm sure you've all heard about is the Complete Auto Transit case. It's a U.S. Supreme Court case from 1977. And in this particular case, then, the taxpayer was an out-of-state company that transported motor vehicles that were shipped to Mississippi and transported to Mississippi dealers. Now, the U.S. Supreme Court held that the tax on doing business in Mississippi did not violate the Commerce Clause because it was applied to an interstate activity that satisfied the following four requirements. There was substantial nexus, non-discrimination, was fairly apportioned, and it was fairly related to services received from the state. Now, the key idea here is the substantial nexus, the first prong, and the court did not explain the meaning of substantial nexus, and this term has been the subject of a lot of litigation, too, in terms of exactly what is meant by substantial nexus. And one of the other key cases is the Quill case from 1992. And this particular case, it was a sales tax nexus case, and it concerned mail order sales of office supplies. And even though this case concerned mail order sales, it's currently being applied to internet sales then too, in some of the more recent developments. And based on Quill, many courts have held that physical presence is not required for income tax nexus, but it is required for sales tax nexus. In terms of the decision, then, there is no collection responsibility exists without substantial physical presence in the state. And the court discussed the distinction between the Commerce Clause and the Due Process Clause nexus requirements. The court explained that the two claims are closely related, but both clauses impose distinct limits on the power of the state to impose a tax. Now, a state may have the power to tax a particular taxpayer under the Due Process Clause, but the state may violate the Commerce Clause. And in this particular case, then, they held that due process nexus existed, but Commerce Clause nexus did not exist because there was no substantial physical presence in this case. And as the court explained, then, the two concepts are similar, but they reflect different constitutional concerns. And then, as I explained earlier, in due process, you can't deprive a person of life, liberty, or property without due process of law. And the due process analysis considers whether an individual's connections with the state are substantial enough for the state to exercise power over the individual. Now, for the Commerce Clause, then, this gives Congress the power to regulate commerce among the states. And there's the concept of the negative dormant commerce clause, which really forbids states to discriminate against trade. And this is where the complete auto test comes into play and the four-pronged test that I mentioned earlier.
Chuck, just to mention, both
Sure.
the due process and the commerce clause apply to Puerto Rico. So anything that has to deal with interstate commerce, even though we are not a state, we are a territory, it's similarly applied into Puerto Rico. That's why, we keep very close watch on what's going on the states because, it's going to be the same for Puerto Rico.
Right. Thanks for pointing that out. Yeah, thank you. Then also, you probably heard then too, there has been some legislation proposed in Congress then too. And first of all, there's the Marketplace Fairness Act. And actually, this has been proposed in different previous Congresses then too. And most recently was proposed in the last Congress in 2015. And also there was similar legislation introduced in the House. And then briefly, this legislation would give states the option to require remote sellers to collect and remit sales and use tax on sales to in-state residents, even if the retailer has no physical presence in the state. And now this legislation from 2015 was similar to the legislation that was introduced in 2013. Actually, back was passed by the U.S. in 2013. I also want to point out there is a small seller exception of $1 million. But there has been quite a bit of opposition to the federal legislation, and some of the main reasons for this are it constrains internet commerce, it erodes state sovereignty, the compliance burden by forcing businesses to track thousands of tax codes, also the disproportionate effect on small businesses, keep track of this. Then also, last in two, the House Judiciary Chairman, Representative Goodlatte, he proposed an alternative seller Nexus solution, and he released last August a quote decision draft that followed a hybrid approach for sales. And under this, a state imposes sales or use on a remote sale of a product or service only if the state is the origin state for the sale. The tax applied using the origin tax that applies to non-remote applies to remote sales, and the state participates in the state tax clearinghouse. And this would use the tax rate of the destination state. And like I said, just a draft proposal was introduced, but it's something I think we're considering. And I expect legislation, at least to the Marketplace Fairness Act, will be introduced during the current Congress too.
Chuck, sorry to interrupt you. Could you talk a little bit closer to the phone? Your conversation is breaking out.
Okay. Yeah, I'll move it closer. I'm sorry.
Mm-hmm.
Okay.
Thank you.
Is that better then? Okay.
Yes, better. Thank you.
Okay. And then the state approaches to expanding Nexus. There's four main approaches. There's click-through Nexus, affiliate Nexus, the remote retail notice and reporting requirements, and also there's the anti-quill or economic Nexus. And then I put together a map then too, basically kind of summarizing what's going on. And you can see, I think, a good example of all that's going on with all the different colors here and so forth. And also I've got notes across the bottom then to point out too. But it's interesting that you can see states that have click-through Nexus, affiliate Nexus, or both, which is purple, or if it's been proposed. And then also the kind of the stripe lines then, those are states that have recently adopted the so-called anti-quill legislation or regulations too. So I want to point that out. But it's kind of a good summary in terms of what's going on here too and how much activity there's been in this area recently. Now the first concept then is click-through Nexus, and this was when it was first started, it was actually nicknamed the Amazon rule. And under this, and it actually started in 2008, New York State was the first to enact it. And under this, an out-of-state taxpayer may have sales tax Nexus if the entity has an agreement to pay an in-state resident commission for sales made through clicking through a link on the in-state resident's website. And quite a few states have adopted this, and by and large, the provisions are fairly consistent among the different states. And then in most states, this is a rebuttable presumption of Nexus, and also most states have some type of a sales threshold. A lot of states, $10,000 of sales in the state the preceding year that must be satisfied. And some of the states that most recently adopted Click-Through Nexus are Michigan, Nevada, Ohio, Tennessee, Vermont, Washington in 2015, and Louisiana last year. And then another one of the four main Nexus concepts is affiliate Nexus. And this, I want to point out, is really very broad among states. You've got to be careful among states in terms of exactly what they provide. This is there's some type of activities on the seller's behalf in a particular state. I'm going to point out too. Originally, there was some type of and it had to be an affiliate type of an ownership connection between the two. But some states have moved away from that now too. So there have to be any type of an ownership connection between the entities. And it's kind of an example of what I'm talking about. I got some of the provisions of I'll go briefly some of the provisions of the Michigan statute then too. I'll give you kind of an idea of what type of connections we're talking about. For instance, the Michigan provides that a seller of TPP is presumed to be engaged in the business of making retail sales in the state if the seller or a person, including an affiliated person, other than common carrier, perform any of the following activities in Michigan. And this includes such things as selling a similar line of products under the same or similar business name. They use, employ agents, representatives, or independent contractors in Michigan to promote and facilitate sales, or maintains, occupies, or uses an office, distribution facility, warehouse, storage place, or similar place of business in Michigan to facilitate delivery of the product. Uses, with the seller's consent or knowledge, substantially similar trademarks, service marks, or trade names in Michigan. Delivers, installs symbols, or performs maintenance repair services in Michigan. So that kind of gives you an idea of the type of things we're talking about. And really, what they're really looking for is the activities that are significantly associated with the seller's ability to establish and maintain a market in the state. So like I said, it's really varies state to state. So I really need to look at the particular statute to see what type of activities are included in this. And then also some of the states that have recently adopted this, Michigan, Nevada, and Ohio in 2015, Louisiana and Oklahoma substantially expanded their affiliate nexus in 2016. Now, the third main area of sales tax nexus are the notice and reporting requirements. Actually, Colorado started this back in 2010. They're the first state to enact a remote seller notice and reporting requirements. And the Colorado statute then has three different requirements. First of all, there needs to be a notice on invoices to the Colorado customers that taxes due on non-exempt purchases. The second requirement is an annual notification to all Colorado purchasers showing the amounts paid by them for Colorado purchases. And this is in place if the purchaser buys more than $500 in goods from the retailer, and this must include dates, categories, and amount of purchases. And the third requirement is an annual statement for each purchaser that's filed with the Colorado Department of Revenue. And this statement must list the customer's names, addresses, and total amount spent. And also then some type of notice requirements has been enacted by Kentucky, Louisiana, Oklahoma, South Dakota, and Vermont. I do want to point out, though, that some of the states, they do not have all the three requirements that Colorado has. They may just have, for instance, like the first or the second requirement then, too. And also I wanted to mention that recently Alabama, they've enacted some legislation that really follows a little bit of a different approach. This is Senate Bill 86. And this law, they really give the Department of Revenue broad authority, and they grant the department the power and authority to require reporting of retail sales and customer notification within constitutional limitations when the seller does not collect sales or use tax on Alabama transactions. And this approach is really different because it provides the department with broad authority to promulgate regulations that impose notice and reporting requirements. And at this point, it's not really clear exactly what the Department of Revenue, what they're going to do then. So we're assuming it's going to be similar to what Colorado or some of the other states have done, but it remains to be seen exactly what they're going to do. So we'll definitely be watching for that.
As Javier is going to be explaining later on, Puerto Rico, it's modeling its requirements after Colorado's requirement. They're not exactly the same, but very similar. So we're going to be seeing that later on the presentation.
Okay, thank you. And And also, these requirements have been somewhat controversial then too, and they've actually had a long litigation history then too. And then most recently then, in February of last year, then the U.S. Court of Appeals for the 10th Circuit upheld the constitutionality of Colorado's requirements. And then really they held that the notice and reporting requirements did not violate the Dormant Commerce Clause because they do not discriminate against or burden interstate commerce. And also they held that Quill did not apply, and they looked at previous U.S. Supreme Court and 10th Circuit decisions, which really construed Quill narrowly to apply only to the duty to actually collect and remit taxes. So they held that Quill did not apply to these notice and report requirements then. And then a few months ago, on December 12th, the U.S. Supreme Court denied the petition for cert. So now the Court of Appeals decision is the final decision which is controlling, so it has been found to be constitutional. And then really the denial of cert, like I said, it basically the Colorado regulation stands in too. And during this time since they were enacted back in 2010, they actually have never been enforced at this point since there was all this litigation pending. So then recently then the Direct Marketing Association and the Colorado Department of Revenue, they've reached a settlement agreement that they're going to really start enforcing these requirements then too. And this agreement provides that the department will not require compliance with the notice and reporting requirements until July 1st of this year, and will waive penalties for non-collecting retailers who fail to comply with these rules prior to July 1st. And it appears from this agreement that the first required annual summary forms to the customers will be due to customers by January 31st, 2018, and the customer information reports will be due to the Colorado Department of Revenue by March 1st, 2018. And then also I just want to point out the fact that this has been found to be constitutional, this may encourage other states to enact similar notice and reporting requirements. So it's definitely something to watch out for. And then the fourth area of sales tax nexus then is actually, these are very recent developments. And these stem from a U.S. Supreme Court and a concurrence by Justice Kennedy on an opinion that was released on March 3rd of 2015. And he's got some language here which has received considerable attention. And he really said that the legal system should find an appropriate case for the U.S. Supreme Court to re-examine the Quill decision. And Justice Kennedy emphasized that the Internet has caused many changes in the way that consumers purchase items since Quill was decided back in 1992. And according to Justice Kennedy, given these changes in technology and consumer sophistication, it is unwise to delay any longer a reconsideration of the court's holding in Quill. So a lot of the states have almost taken this to be an invitation then really to challenge Quill and see if they can get the court to reconsider it then too. So basically, since this case was decided about 2 years ago, then there's been a lot of activity in these so-called anti-Quill developments. And Alabama was actually the first state to address this and to challenge it. And they promulgated a regulation which requires out-of-state sellers to collect and remit sales tax in the absence of physical presence in the state. And this regulation took effect on October 22nd, 2015. It applies to transactions occurring on or after January 1st of 2016. And then two conditions must be met in order to be required to collect and remit sales tax under the regulation. The prior calendar year retail sales of TPP in the state must be greater than $250,000 based on the previous year's sales, and the seller performs one or more of the activities listed in Alabama Code Section 402368B. And then I provided a couple of examples then too of some of the activities that are listed in the statute then too. And this includes such things as qualifying to do business or registering with the state to collect sales and use tax, using employees or agents operating in Alabama to sell, deliver, or take orders for the sale of TPP or taxable services, or using a franchisee or licensee operating under its trade name. I also want to point out that this regulation is being challenged, and in June of last year, Newegg filed litigation challenging this regulation, and that's been filed with the Alabama Tax Tribunal. In South Dakota was actually the first to enact a statute which challenges Quill. And this was effective on May 1st of 2016. But because there's been pending litigation, it actually has never taken effect, though. It's waiting. There were provisions in the statute then, providing that it would be suspended if there was pending litigation. This is particularly important because other states are tending to follow the same model that the South Dakota used. And what they did was basically they instituted an economic nexus standard for sales tax. And under the statute, remote sellers are required to collect and remit sales tax on sales of TPP, any product transferred electronically or services delivered into South Dakota, if they meet one of two thresholds in either the previous calendar year or the current calendar year. The gross revenue exceeds $100,000, or the seller sold 200 or more separate transactions. And as I said, this really is a direct challenge to Quill's physical presence requirement. And the state then, as part of this, then they had detailed provisions then too in terms of how it would proceed with the court in terms of the state challenging it and the taxpayers challenging and so forth then too. So there's detailed provisions there. And actually as part of this then, any appeal of a lower court decision goes directly to the South Dakota Supreme Court and must be heard as expeditiously as possible. And also the legislation explains right on its face that it's intended to directly challenge Quill. And then recently then, on March 6th of this year, there was the Wayfair case. And in this case, South Dakota versus Wayfair, the state filed a declaratory judgment action asserting that this legislation is valid. Now, the remote retailers removed this case to the U.S. District Court for the District of South Dakota. And then on January 17th of this year, the Federal District Court granted the state's motion to remand the case back to state court and held that the state's complaint doesn't necessarily raise a stated federal issue. So then less than 2 months later, after the case was remanded back to South Dakota on March 6th, South Dakota Circuit Court granted motion for summary judgment and held that the law is unconstitutional. And the court explained that the law violates the physical presence requirement for sales and use tax under Quill and its application of the Commerce Clause. The court explained that it is duty-bound to follow applicable precedent of the U.S. Supreme Court. Accordingly, the court was required to follow Quill even when changing times and events clearly suggest a different outcome. It is simply not the role of a state circuit court to disregard a ruling from the U.S. Supreme Court. So they really were bound to follow Quill then too, even though things have changed quite a bit since it was decided back in 1992. Now, this is an important case because this is the first time that the court has considered the constitutionality of legislation that disregards the physical presence requirement for sales tax. Now, the court's decision is not really a surprise, but is an important step in the path to challenging Quill. As provided by the law, an appeal of the circuit court's decision will go directly to the South Dakota Supreme Court. And as I said then, other states are really have been enacting similar legislation then too. And recently then, on March 1st of this year, Wyoming enacted a law, House Bill 19, which also challenges Quill's physical presence requirement. And it's similar to the South Dakota law. And under the Wyoming law, remote sellers will be required to collect sales tax once they meet one of two thresholds in either the current calendar year or the immediately preceding calendar year. The seller's gross revenue from the sale of TPP missions or services delivered into Wyoming exceeds $100,000, or the seller sold TPP admissions or services delivered into the state in 200 or more separate transactions. So it has really exactly the same thresholds as are in the South Dakota law then too. And then similar to the South Dakota legislation, Wyoming has some provisions then too for challenging this too in the courts. And then the Wyoming requirements are currently effective July 1st of this year. Then also very recently then, just a few weeks ago, North Dakota enacted a similar law, Senate Bill 2298, which also challenges Quill's physical presence requirement. And this also is very similar to the legislation I just discussed then too, and it has the same $100,000 or 200 separate transaction thresholds. Now this is a little bit different because it is effective on the date that quill is overturned. So basically it's not yet effective. And as a result of that, then the legislation does not include any procedures for challenging the statute because it is contingent on quill being overturned. So at this point, then it's very uncertain, when, if ever, this will take effect. So I just wanted to point that out. And then another development in this area then too is Tennessee also promulgated a regulation then too. And their regulation then, the out-of-state dealers who engage in the regular or systematic solicitation of consumers in Tennessee through any means and make sales that exceed $500,000 to consumer in the states during any calendar year have substantial nexus with the state. Now, by March 1st of this year, the dealers were required to register with the Department of Revenue for sales and use tax purposes, and they had to acknowledge that they will begin to collect and remit sales tax to the Department of Revenue by July 1st of this year. However, there's a recent court decision then too. So recently then, on April 10th, there's a Tennessee Chancery Court decision, and this was the American Catalog Mailers Association versus the Tennessee Department of Revenue. And in this case, since the Tennessee Chancery Court granted a motion by the Tennessee Department of Revenue and two parties representing affected businesses prohibiting enforcement of the rule. And under the agreed order, the enforcement of the rule is prohibited pending entry of a final judgment in this action. And the court explained that preventing enforcement of the rule will alleviate uncertainty in the marketplace. Now, they did explain, though, that sellers that fall under the rule may voluntarily comply with the requirements while the action is pending, and the department is allowed to continue with registration and collection procedures for those sellers who voluntarily comply with the regulation while the final judgment on the complaint is pending. Then also, there's another very recent development in Massachusetts. Then the Massachusetts Department of Revenue issued Directive 17-1, and this is effective July 1st of this year, and it's really an administrative bright line rule. And on this, then basically, then requires remote internet vendors to collect sales or use tax if during the preceding year there's over $500,000 of Massachusetts sales, and the taxpayer made sales for delivery into Massachusetts in 100 or more transactions. And the notice then, directive, provides guidance on the Massachusetts General Sales and Use Tax jurisdictional standard applies to internet vendors, and how the application complies with the due process of commerce clauses. And in applying the state sales and use tax collection requirements on a case-by-case basis, the state has chosen to adopt, for clarity and administrative simplicity, an administrative bright line rule. And after establishing this rule, most of the directive explains how the rule complies with the state law and the requirements of the due process of commerce clauses as provided in Quill. And this rule is a unique approach. Rather than promulgating a new regulation or enacting legislation, they've really chosen to interpret existing law in a way that complies with the law. And I think it's interesting then too how they really kind of a Quill analysis and explain how things have changed since it was decided back in 1992. Now, the directive draws a clear distinction between the mail order vendors in Quill and the current internet vendors. And the internet vendors were not the subject of Quill, and internet commerce was unknown at the time of the case, but the directive identifies several activities that create an in-state presence for internet vendors. One of the things are large internet vendors have software that is downloaded on an in-state customer's computer to make shopping easier. Also, internet vendors use cookies that are stored on their customers' computers when the customer visits the vendor's website. And lastly, internet vendors contract with providers of content distribution networks, or CDNs, to use local servers to accelerate the delivery of their web pages to their customers. So by these different things, basically, the Department of Revenue is explaining that the internet vendors, in a way, they have a physical presence in the state with these different computer applications. And also, last year, Vermont enacted legislation, House 873, and this legislation is contingent. It's effective on the latter of July 1st, 2017, or basically after Quill is overturned. And I want to point out this provision as enacted will not become effective if the courts or Congress fail to overturn Quill. So really it's like I said, it's very contingent at this point too. And it's somewhat similar to the other states then too, which provides a definition of vendor, and then it's got thresholds of $100,000 or at least 200 individual sales transactions. Okay, and now for our next polling question. Which of these remote seller developments may have the greatest effect on you? The Colorado notice and reporting requirements, the recent Massachusetts pipeline rule, Alabama collection and remittance, or none of the above? So I'll give you a minute to answer that. Okay, so I'll get a little more time then. Looks like you have responded. Okay, I think it's just in a few seconds, and I'll go ahead and close the poll then. Okay, so then about half of you then, you said the Colorado notice and reporting requirements, which of course makes sense because as Maria explained, that's looks like that's under the Puerto Rico's and following then too, very similar requirements in Puerto Rico then too. So that was, about half of you chose that, and then also another one was none of the above was the second most popular answer. And also in terms of likely development, I'm sure there's going to be a lot more activities in this area is going to continue then too. There's been a lot of sales tax nexus legislation introduced in many states during this past year. Also, as I stated earlier, then the U.S. Supreme Court's denial of cert in Direct Marketing Association may encourage other states to enact similar notice and reporting requirements. And also, states are expected to continue to challenge Quill's physical presence requirement. As I explained, a lot of the states with the different, legislation or regulations or administrative guidance then too, there definitely has been a very recent trend of really challenging Quill then too, and trying to encourage the U.S. Supreme Court to accept the case and really address Quill then too. So now our next part of the presentation, Javier is going to go over Puerto Rico's plan to tax the internet sales. So Javier?
Okay, thank you, Chuck, for that excellent summary of what is happening in the U.S. As you have seen through the presentation that Chuck did, Quill's case is being challenged. Around 8 states approved remote seller nexus rules to try to collect the tax on internet sales. Tennessee has rules in which $500,000 in sales by any means make you have nexus in the state. Examples like Massachusetts, in which having 100 or more sales for delivery in the state creates you a nexus. But what is Puerto Rico doing in regards to these internet sales? Puerto Rico is doing something because they are trying to collect the tax on those internet sales. The current state of taxation for online purchases in Puerto Rico include rules pretty similar to the ones that Chuck discussed. Here in the island, we have the click-through nexus rules, we have the affiliate nexus, and we have to pay the use tax on imports of items to be used in the business, or pay the tax locally on items to be used in the business. If you are not a business, the current provisions require that you raise your hand and voluntarily declare and pay the tax on the items that you imported. For those of you who don't know what is the click-through nexus in Puerto Rico, for example, you have someone in Puerto Rico that is referring persons to an internet link, and based on those referrals, you have more than $10,000 in sales in Puerto Rico. That creates a nexus for the entity that is out of Puerto Rico. In regards to the affiliate nexus, these rules make reference to entities that are out of Puerto Rico, but a merchant or an affiliate in Puerto Rico is doing something for the benefit of that entity out of Puerto Rico. And depending on what they are doing, that may create a nexus. With regards to the return, that is the portion of the center of the slide, this causes confusion whenever you have an import through the U.S. Postal Service or any other carrier. The items must be declared before the end of the month, and by the 10th day of the month after the import, a tax on imports monthly return must be filed. This rule is for items for resale and also for use in the business. On the other hand, if you have failed to declare the imported items, you can pay for the corresponding use tax with the sales and use tax return that is due on the 20th of the month following the month of the import. So what are the plans of the government to increase collections of sales tax on Internet sales? For these purposes, House of Representatives present Bill 849 on March 1, 2017, which has the purpose of providing the Puerto Rico Treasury with the necessary tools to collect the sales and use tax on the sale of taxable products in Puerto Rico over the Internet by entities with no physical presence in Puerto Rico, for example, Amazon. This bill established some notification and reporting requirements for remote online sellers to the Puerto Rico Treasury Department. The purpose of providing such information is because in that way the Puerto Rico Treasury Department will be able to collect the tax on those sales which currently are voluntarily declared by the consumers. As every amendment to the sales and use tax rules, the bill also established some penalties. The original bill includes certain penalties of $5 and $10 per instance for the failure to make certain notifications to the consumers. And I said original bill because the project was already amended by the House of Representatives during this week. Now, in order to keep you awake, here's our third polling question. How often do you buy online for business or personal use? Every month, once every quarter, 1 or 2 times a year, or never? I will give you some time to respond to the question. So many of you respond, more than 50% of you respond every month. So that's interesting because all of you are supposed to be paying the use tax. So I hope so. So let's continue with the presentation. Okay. The original Bill 849 established a new definition for retailers, specifically non-withholding retailers. This definition makes reference to a non-resident person that sells tangible personal property for personal use to customers or consumers in Puerto Rico, and also includes non-withholding retailers that elect to be treated as retailers. We have to mention that the amendment to the bill, which happened this Tuesday, eliminated the reference to the term retailer and amended the definition of the term merchant to include persons that continuously make sales delivered by mail in the ordinary course of business to Puerto Rico. A merchant that makes sales delivered by mail and whose only contact with the island is its customer, that is a resident or a person engaged in trade or business in Puerto Rico, will be classified as a non-withholding agent based on this amendment. However, will be required to make some notifications that we will explain in the next couple of slides. Originally, Bill 849 required a notification letter from the seller to the customer establishing that their purchases may be subject to the tax and the responsibility of filing the declaration of imports and the monthly imports return. This requirement was kept with the amendments, And in addition, the original project also required to the seller to send a notification to the customer within 10 days of the transaction, indicating that the date of the transaction, categories of items that were purchased, amount of purchases, and a reminder of the responsibility to pay the use tax on those purchases. With the amendments, these requirements should be made in a quarterly basis, and instead of the customer, this information must be sent to the Puerto Rico Treasury Department. Another change introduced this week is that the non-withholding agent making sales delivered by mail will be required to inform the buyer about its responsibility of paying the use tax corresponding to the import. The notification must be made in the invoice, receipt, or any other document. So basically, we will need to wait until the project is approved to know the specific requirements for these merchants. An additional point that was introduced by the amendment is that the 1% portion corresponding to the municipality for the use tax on those imports will be included in the declaration of imports that is filed with the Puerto Rico Treasury Department and will also be collected by the Puerto Rico Treasury Department. Then the Puerto Rico Treasury is going to send the money corresponding to each municipality. In addition, the original bill and the amendments also require the seller to send a notification to the customers by January 31st of each year with a summary of the annual purchases made, including the name and addresses of the seller and buyer, dates of the transactions, categories, and amounts of the purchases. In addition to such notification, it requires a reminder of the obligation to pay the use tax. The original bill contains an additional requirement of an annual customer information report to be filed by March 1, but this requirement was eliminated in the amendments to the bill during this week. And finally, we have the penalties section. The original bill, as it was filed by the House of Representatives, established penalties of $5 to $10 per instance for the failure to submit the required notifications. Now, with the amendments, the penalties will be the following. For the customers in Puerto Rico, it runs from 5% to 50% of the insufficiency for the failure to remit the use tax, and repeat offenders can be fined with 100% of the insufficiency. Failure to file the sales and use tax returns when required may trigger a penalty of 10% of the liability reflected in the return. And for the sellers, instead of $5 or $10 penalties, we have $100 per instance for the failure to notify the customers of their responsibility to pay the use tax, a $5,000 per instance for the failure to remit the quarterly report to the Puerto Rico Treasury Department, and also a $500 penalty for the failure to send the annual report of their purchases to the customers. That is supposed to be sent by January 31st of each year.
We participated of some of the hearings conducted by the House of Representatives Commission on this bill. And the same day we were there, the Department of Justice of Puerto Rico was giving their position on the bill. And it was very interesting to hear the analysis they made and to conclude that the law is what is called a good law. So it's under their analysis and review, it's an enforceable law. And it always comes to mind the question of how the Puerto Rico Treasury is going to be able to enforce the compliance of out of Puerto Rico's online sellers, those that do not have any type of nexus with Puerto Rico, only the purchasers that they have in Puerto Rico, how the Puerto Rico Treasury is going to be enforcing or able to enforce this. And I guess, Chuck, that the same question is made in some of these states that have similar reporting requirements. And I guess it might be a matter of enforcing the due process or the Commerce Clause rules.
Oh, exactly, like those same issues, exactly, that we discussed earlier. You're right.
Mm-hmm. Okay, so it's, once this bill is approved, and when approved, it's going to be very interesting to see how the Puerto Rico Treasury Department is going to be able to get all this information, because what they're betting on is in getting the reportings from the remote sellers. So in order to go after the local purchasers that are not reporting their purchases and paying the sales and use tax on those purchases. Another very interesting thing of the bill, which was added in this week, was that the Treasury Department is going to be collecting the whole 11.5% on these purchases, which includes the 1% for the municipalities. And you are all very aware of, the feud that the Puerto Rico Treasury Department has with the mayors of all towns in Puerto Rico. So it's going to be very interesting to see once this money starts coming in, when it starts coming in, how Puerto Rico Treasury is going to be diligently delivering this money to the municipalities. So, we're going to keep our eyes and ears open to see everything is going to be developing on this matter. Before we go to the questions that we have on the chat board, we want to make you another question. This is the last polling question. And we would like to know, how often do you download applications or programs for business use? And we'll give you some seconds there for you to answer. Okay, seems like 74% of you do download programs or applications for business use. It's very important to keep in mind that downloading a program or an application is like buying a program from the shelf in one of the stores. So these downloads are subject to the sales and use tax as those that you directly buy from a store. So keep in mind that you should be including these purchases on your sales and use tax return that you file on the 20th every month. All right. With that, we'll go to some of the questions. Javier, we have a question asking us to review again the click-through rules that we have in Puerto Rico. Could you please do that?
Perfect. Basically, when you go to a store and to a local store, and someone mentions that, hey, enter to this link to see your specials or whatever, and whenever that happens, and if the entity that is the owner of that link, let's say that it's not a Puerto Rico entity, has more than $10,000 in sales to Puerto Rico, that may create a nexus with Puerto Rico, even though the company in Puerto Rico is not making the sale. They are referring customers to that out of Puerto Rico entity, to that entity out of Puerto Rico, sorry. And if they have more than 10,000 in sales, then that may create a nexus. That's basically a simple example of what is click-through nexus in Puerto Rico.
Okay, thank you. Another question we have here is, why are internet sales being taxed at 11.5% while the purchases to non-resident suppliers are taxed at 10.5%?
Okay, that's the key here in this transaction is if the local customer has a certificate, reseller and municipal exemption certificate. If that is the case, the transaction is subject to the 10.5%, and the 1% is presented at the municipal level as an exempt purchase. If the person in Puerto Rico does not have a reseller municipal exemption certificate, the transaction is subject to 11.5.
And also that question asked the 4% to the designated professional services. Please remember that the 1% from the municipalities do not apply to the designated professional services. They are only subject to the 4%. We have another question, and it's very interesting. If FedEx delivers to a physical address, for example, an employee buys something and it's delivered to his employer's address, and it contains the names of the employer's name, how can Puerto Rico Treasury apply penalties to the person who ordered shipment, and whether there is something in Bill 849 that handles this issue? This is not contemplated on the bill. I guess it would be a matter of rules and regulations by the employer to keep their employees from having stuff delivered to their offices, because that's a very good question. Once these informative returns or reporting requirements are made to Treasury, the address that's going to show up there is the delivery address. So I guess employers in Puerto Rico will have to start keeping an eye on packages coming in which are not for business use, and start regulating that matter. We have a question regarding the download. It says, would this apply to telephone apps? I guess so. Yes, probably. There's some apps that are already charging the sales and use tax. So I would say that these suppliers will be considered remote suppliers also, and probably be subject to the same rules as all other online suppliers. Keep in mind that Puerto Rico is not putting thresholds as to make online remote sellers report. So there is a minimum of sales or a minimum of deliveries to Puerto Rico in order to be subject to these rules, like some other states, like Chuck described before. So as it's right now, the Puerto Rico rules would apply to any remote online seller without considering the amount of sales or the amount of deliveries to Puerto Rico. With that, we have taken care of all the questions in our chat box. There is one more. Let me see. Will CPE be granted for this webcast? Unfortunately, no. So we'll keep that in mind for future webcasts. And I have another question here. What about subscription fees paid monthly? For example, QuickBooks Online, which we do not buy the software, but we use their cloud. This is probably considered a service. And as a service, you're subject to auto-impose the tax, either the 11.5 or the 4% if it's a B2B service or a designated personal services. If it's to be used in your business, then you're supposed to be auto-imposing the 4% and pay it on your monthly return on the 20th of each month.
I have to add that in the case of the question related to the 1% of the municipal portion, sometimes merchants forgot to report that portion to the municipalities. And at least in the last couple of weeks, I have seen some efforts from the municipalities in collecting this use tax that is not reported to the municipalities in a monthly basis. For example, San Juan is trying to match the declaration of the declaration of imports and the return that is for the monthly imports return with the returns that are filed with them in a monthly basis. If there is use tax paid reported in those returns that are filed the 10th of each month, they will try to see if you paid the 1% portion to the municipality.
One more question coming. Do you expect reporting requirements to occur retroactively? The bill specifically says that no, the intention is to have this apply prospectively. So anything that had happened before, it's gone. But once the bill is approved and final and become law, then it will be applied prospectively. Remember that the presentation, you will be delivered a link to be able to download already. It was already delivered, so you should be getting an updated message from the conference call, and you can click on that link and download the presentation. So with that, we conclude our presentation of today. Please remember that you can get more information on what's happening in Puerto Rico through all the different channels we have. We have our Kiven mailbag that goes out every last Thursday of the month, our tax calendar, and our web page, and our app, which you can download for free from the App Store or Google Market. Before we disconnect, we want to give very, very much thanks to Chuck for joining us today and giving us that incredible summary of everything that is happening in the States. Thank you, Chuck.
Okay, well, thanks for inviting me. I appreciate that. Thank you.
Sure, and thank you to all of you for connecting and keeping us active on providing you the latest information on what's happening in Puerto Rico. Again, thank you, and until the next time.